This is the time of year we meet with clients, and it's required minimum distributions for those people. And there's been some changes over the last several years. So it's what we refer to as RMD planning.
RMD, so required minimum distributions.
And it's the one thing that the government demands that you take money out. In fact, if you don't take money out, the penalties can be pretty severe, up to 50%.
Yeah, this is, I think, a great moment for planning.
Right.
And we do this every year with our clients. And so if anyone who has a rollover IRA, a 403B, a 401k, any of these qualified retirement plans,
correct,
and they get to a certain age, we'll talk about that in a minute, but they get to a certain age, they have to start taking out what's called the required minimum distributions.
Right.
So it's not a maximum. They can take more than that, but the government says you have to take this. And
so what does that dollar work? I mean, if I have $1 million in my retirement account, what do I have to take out?
Yeah. So it's
approximately.
Yeah, it's a table. And so every year it changes, but at the beginning of it, when you first turn 72 is the current age, you have to take roughly 3 to 4%.
Okay.
Is what that comes out to. So
$1 million between $30,000 and $40,000 a year.
Right.
To start.
Yeah. And as you get older, that percentage becomes a little bit larger as you go up and up. And the idea is that as your account balances come down, the amounts get larger, that you have somewhat of an even stream of payments over your life.
And some of the pushback I get from clients is that, why do I have to pay taxes on this?
Yes. Yeah.
And I always have to remind them, I said, listen, you got a tax deduction when you put money into it. You got a tax deferral. In other words, all the earnings that it made over 30 years or so, you didn't pay any taxes on that. And the government just says, okay, it's time. And they tell you take it out.
And they want to tax it. Yeah.
And they want
to tax it. That's the key piece here. And that's why planning matters, is because, one, you want to have enough money for your life. That's kind of first priority. But two, you're going to get taxed on this. This is money that you didn't get taxed on when you earned it. You put it into a 401k or some sort of qualified plan. And now that you're past 72 years old, you have to take it out, and it comes out as if it's income. So you're taxed on it. And that's what a lot of people in their retirement, that's what they live off of. That's the dynamic they're in. So what we run into as far as RMD planning, you retired, great. I don't have any income. Okay, this is good. This is good. We're taxing.
What I call cutting the umbilical cord.
Yeah, right.
It's hard for people.
Right. You've cut it. You've retired. You've done it, and now you start your Social Security.
Right.
Okay, that's coming in. Wonderful. I got a stream of payments, and now I'm taking retirement. Both of those can be taxable if you have enough. And they start getting to a point where they say, "Hey, I'm making more money than I need."
Right. I don't really want more money. I can reduce my I can reduce my taxes. Right.
Right. I'm paying taxes on this. I don't need it. Can I just delay some of this? And the answer for RMDs, at least, and Social Security is no. Like it's coming out to you.
Right.
You're receiving it. And so the RMD planning, some of it is planning when you're retired. Some it's planning now. We've had some clients that as they are funding their retirement, they've been a good saver. They've put money into these plans. We get to a point and realize you don't need more money in your retirement plan, your qualified plan, because when you get on the other side of 72, you're going to have this large amount of taxable income that it's nice to have the income, but it's more than they need, and they're just paying extra taxes on it.
Yeah, so I mean, we met with a client yesterday. I'm just thinking they had multiple accounts from business as well as previous accounts they rolled over, but they had like 5 different accounts. Did they have to take their required minimum distribution from each one of those accounts?
Yeah, that's a great question. We get that a lot.
Right.
It's most common that people will take the RMD required from each account from that account.
From that account.
I have 50,000 here, I have 500,000 here, you take a little bit from each. But that's not how the rule is written. What the IRS looks at is your total amount of qualified plans, 403Bs, IRAs, whatever it may be, and adds all that up and says this is the number that you have to take. And then you can take that all from one account if you prefer to. You could take a little bit from each account. We've had some clients that are in some IRA-related annuities, but it makes sense not to touch that money.
Right.
And so we'll take whatever that value is they're supposed to take out. We'll take it out of a different account that's still a qualified account and come out. So there's flexibility of which account to use, and there's even flexibility of when to take it during the calendar year. So you take it monthly, quarterly, once, but you have to take it. And the penalty, if you don't take it, is 50%.
50% of what you're supposed to take out. It could be a pretty steep penalty.
Yes, it's a huge penalty.
So again, the value of your accounts, whatever IRA, it could be a single account or multiple accounts, what we refer to as qualified. Anything where the deposits went into the account and got a tax deduction for it, and it falls under the IRS code for qualified money. They determine the value of your account on December 31st of the previous year. So the following year, then on January 1, you could start taking out your RMDs immediately. So it's a divisor, but we'd use a percentage because it's a lot easier to kind of calculate that for most people. but it's a dollar amount based upon that value based on December 31st
Yep.
of the previous year.
Yeah, based on your age. Yep. And you have to take it out. And for most folks, that's what they're living off of. So it's fine for them to take it. It's a normal structure. But what we wanted to kind of talk about today is rethinking that a bit, rethinking how you take these things out. What's the best method? And one of them that is just interesting at the moment. The benefit of these plans is that you put the money in, you weren't taxed on it, and then it grows at a certain investment rate, and then you take it out in the future, and then you are taxed on that larger amount. Well, the concern that people have is, well, if the tax brackets are lower today, and I'm going to be in a higher tax bracket, or brackets will just be higher 20 years from now, does it still make sense for me to put the money in? And it's a good question. Most people are in their earning years, and so they're in a high tax bracket. And then at some point they retire, their earnings fall off, and now they're in a lower tax bracket as for Social Security and RMDs. That's not the case for everybody. There's a number of folks who get pensions, who get very large RMD and retirement funds, to where they never really fall into that lower tax bracket. So it becomes a question if you're paying 28% now.
And some of the things that you use for deduction, like for example, interest on mortgage, and even the contributions into your retirement plan.
Yeah.
So when you retire, you no longer have earned income, so you can no longer put money into a retirement plan. So therefore, I've had many clients where they actually had a net increase in net income after they retired, because they were putting the maximum into their 401k, let's say. And by the time we took that out and we looked at their retirement, they were actually making more money in retirement. And they said, "How can that be?" And I said, "Well, you've planned well, but that's just the nature of the beast, so to speak."
And even same money with just higher taxes, you're in a different tax world. And so that planning becomes important, not just in I'll get there and I'll be fine, because kind of job one is make sure I have enough. But job two is let's be strategic on your taxes. So one comment is we always like to do with our clients is think through how much they're putting in to make sure they're not putting in too much. And for most people, that's not the issue. Most people, you put in more, right?
Most of our clients, we try to encourage them to put more, to max out their
And probably everyone in my generation, they're in their 30s, they're in their early 40s. They should probably be contributing. It's very rare that someone at my age would have already put in enough. And we say, slow down. But somebody in their 50s and perhaps in their 60s, that's a conversation to make sure they're not overfunding it. The other one is when you use it. Most people wait till 72. It used to be 70. That was the normal age when you could take it.
So they changed the law back in 2019. Just so you're aware, just kind of giving you some facts. You're listening to us and watching us on YouTube, but they changed the law back in 2019. So they increased the required date. So it used to be 70 and a half.
You had to take them at 70.
70. And now they've changed it out to 72. And there's legislation to actually extend it out even a little bit further for some people that are younger, like up to 75, I think, is what they're looking at in some of the legislation, right?
So the traditional way that you did this is if you could, you waited as long as you could to take them. That allowed it to grow and avoid those taxes. So you waited till 72.
Right.
But one of the topics of discussion for a lot of clients is, now you're retired, say they're, let's say they're 67. They just retired. They still have a number of years before they have to take any RMDs. But they anticipate that tax brackets are going to increase, or tax rates will just increase. And so rather than waiting to 72, which is the traditional knowledge or traditional approach, for some people, it makes sense to start taking the money now, get taxed on it now and get the money out of the plan, even though you don't have to start taking some early distribution.
Yeah, because I think some of the logic early on when I started in the career going almost 40 years ago, IRAs, you said, okay, we want to put as much as we can into IRAs, because your tax bracket is going to be lower when you retire. So therefore the income that you're receiving. But in reality, we're sitting on almost a $31 trillion budget deficit. We have a debt and we've got all these Medicare and Social Security payments and everything else. And the people that are contributing into these plans, like for example, just take Social Security for matter, for one case, we don't have enough contributions to really hold that plan forever. So that means taxes most likely are going to increase, and we're going to see sunsetting. During the Trump administration, they kind of reduced the taxes, but that all sunsets in 2025.
2025. It feels like this is a far off thing, but that's coming up. And a few years ago, I think the general consensus is it'll get extended. That's whoever's in the White House, they're going to extend it because this is a great policy. Everyone's enjoying this. To your comments, where we're at in the world today, and the obligations that our country has, that's a real easy way to quote unquote raise taxes without doing anything. Just don't extend it and then all the tax brackets go back up.
And there's been enough case studies that we've looked at. I mean, you could, if you were receiving about $100,000 a year just from your retirement account, you would end up paying about another $4,000 a year after the sunsetting versus what you were paying prior to that. So, you know, the question is, can you do anything to reduce that? And there's some planning aspects.
Right.
You know, I think the conversation always goes to Roth.
Yes.
I think for people that are at retirement age or very close to it, Roth is a really expensive process.
Yeah.
Now, if you're 30, 40 years of age, it is a logical process. So
yeah, a Roth, just to kind of make sure everyone knows, a Roth IRA is a conversion you can make. You can take a traditional, either a 401k or an IRA, and you convert it to a Roth IRA. And what you do is you basically pay all your taxes right then. You tell the government, I'm going to trigger all my taxes. A Roth IRA is nice in that it still stays, the interest and the growth is still tax-free, except you pay all the taxes when you put the money in or if you do a conversion at that moment. So the benefit being, you have paid your taxes now, whatever the tax rates are, you lock that in. The money continues to grow in these plans. And when you take it out, you don't have to pay any more taxes because they've already been paid.
Right.
So if it grows for a number of years, you take out that larger amount, it's still tax-free. But to your comment, we've gone through this analysis with a lot of people. So someone in their 60s thinking about retiring, wanting to avoid some future taxes.
Because the cost of conversion is immense.
It's the taxes. So say you got a 401k with $500,000 in it. It's a $500,000 401k that you retired now, you want to convert it. Right. Well, the IRS treats that as a $500,000 on top of your current income. That's a huge amount of income tax you now have to pay. So you might have to pay, say $150,000 of taxes. And what you don't want to do for most people is use that plan to pay itself. You want to use separate money in that Roth conversion.
The amount of time it takes to get back to zero. By the time you take in $150,000 of tax money that it costs you to do the conversion, how long does it take you to get back to the $500,000 that you started with? And then you start to grow on top of that.
Yeah,
again,
a net gain for the transaction.
Right.
Yeah. And so like I said, someone in their 30s, it can make a lot of sense. They probably don't have a $500,000 IRA to begin with, but it could make sense. But someone in their 60s, the numbers often don't pencil out. Sometimes they do, but the pain of doing it, of saying, I'm going to take $100,000, $150,000 out of a different account to pay these taxes, is just so painful.
And I've had a lot of conversation with clients that are in their 60s and they're saying, well, what about Roth? I said, okay, let's take a good hard look at it. And when I give them the actual numbers, they're saying, well, where does that money come from? I said, well, it comes from your other savings. You have either money in the bank or other investments. You may have to pay in. And when they recognize that they have to pay in to pay that income tax, not from the investment itself, but from another source, I have not had anybody that says, okay, I want to do that.
It's usually dead in the water.
Yeah.
It can be a good strategic choice, but it's hard to do. You're listening to Retirement Unlimited with Randy Barkley and Jeremiah Lee. We're both certified financial planners. I'm also a licensed California attorney. And we work together at Tricor Advisors. We help clients build the life they love. And on this show, we talk through life's hard questions, things that we get all the time. We want to talk through that.
Right.
We've been talking today about RMDs. We're going to take a quick break and we'll come back and talk some more about that.